I'm going to get started because I know everyone's in a hurry to get back home to see two 80-year-olds vie to be the next leader of the free world. That's your best and brightest, really? 330 million people? Welcome to the GreensKeeper 2024 annual meeting. My name is Michael McCloskey. I'm the president and founder of the company. And I'm going to talk for about 30 minutes about GreensKeeper, what we do, how we invest, the team, and then I'm going to open up the floor to questions. So we're value investors at GreensKeeper, and yes, I'm a golfer. We're at the Mississauga Golf and Country Club, but that's not where the name comes from. It actually comes from a quote from a famous value investor that once said, "Value stocks are about as exciting as watching grass grow." But have you ever noticed how much your grass grows in a week? So value investing may be boring, to most people at least. I find it incredibly interesting. It works, and yet only 5% of all investors around the globe use it, despite the fact that it's time-tested. And why is that? I'm going to talk about that a little bit later. And as I like to say, my mom and dad are in the audience, and they paid a lot of money to educate me. So mom and dad, thank you for that. And I hope you feel like you got your money's worth. So I studied mathematics at Western University and then proceeded to do a dual degree in law and business, and then started my career in law with the law firm of Aird & Burles in Toronto on Bay Street. And I practiced mergers and acquisitions and securities law. And so practicing law really taught me how to write. It taught me about the rules of the game and how the world of business really works. And after 7 years making partner there, since the time I was a kid, I've always loved the capital markets. And I had an opportunity to join a group of young people in their 30s like me, and we did a management buyout of Eric Sprott's investment bank. And at the time it was called Sprott Securities. It's subsequently been named Cormark Securities. And so I did that for 9 years, took companies public, mergers and acquisitions, really got to understand what capital markets were all about and how the street worked, Wall Street, Bay Street. Taught me when an analyst says market perform, what that really means. So really just understanding how capital markets system works. And after 15 years on Bay Street, I was fortunate. I was able to make some of my own capital. And so I decided to take a year off and recharge and then start to manage my own money. And then some friends and family had expressed an interest in having me do the same, to manage their money the same way that I was managing my own. And that's why I formed GreensKeeper. And that was 2011, late 2011. We're 12 and a half years now into that journey. Started with a whopping $3 million in assets under management on day one. And we're approaching about $140 million in assets today. And obviously that growth is not just due to me. I've got a team behind me. From day one, my brother James, who's recording the meeting for me tonight. I call my brother the human magnet. Well, I like to sit in the closet and read annual reports. I mean, he's a man of the people. And he's really helped me to build awareness of the firm and tell people about what we're doing at GreensKeeper. So thank you for that, James. And then Michelle Tate has been with us since 2017. And for our clients, as you already know, Michelle runs the place. She runs the meetings. She runs the office. She runs a large part of my life. And so she does a great job of onboarding clients, helping me with compliance. Whenever a prospective client or a client needs something, she's on it. So she's really a godsend and a pleasure to work with. Michael Van Loon is a graduate of our summer program. So over the past 4 or 5 years, I've had 9 summer students who are recent graduates or senior students in business programs across the country. 3 of them are in the audience tonight, Jude and Parker, Michael. And as the firm's grown, I found the need for a full-time analyst. So Michael joined the firm full-time after completing his degree at Ivy and HBA, and works with me on the portfolio side. And he's now 1 year into his journey to become a fully licensed portfolio manager over the next 3 years. And again, we see the world the same way. We analyze stocks the same way because we had the same teachers, Warren and Charlie. And then hot off the presses, Rob McMullen, who's in the office tonight, just agreed last week to come on board. He's going to join us sometime in August after he's licensed with the Securities Commission as our Chief Revenue Officer. And Rob brings decades of experience in the financial services industry. He worked at CIBC World Gun Day at one point. He's an entrepreneur and has run a couple successful businesses, so I'm really excited to get Rob on board.
Apologies for the terrible picture that I took.
And not on this slide. Over the last 6 months, our business has grown a lot over the last 12 months. And as a business grows, you need more and more help. And so even my sister has been consulting for me, with me for the last 6 months, and is doing things like updating her website, helping me with compliance and a number of other projects. So I wanted to acknowledge her and the help she's given me. So thank you, Jackie. And as I try to remind the team every day, the only reason for the firm to exist, this is our lodestar, one goal: make money for our clients and protect their capital. And as long as we continue to do a good job of doing that, our business will continue to grow and thrive. And so we try and never lose sight of our objective. And how we do it is really what differentiates us, I believe, from all other managers. So Michael and I spend all of our time reading, studying, and analyzing businesses, not trading. Most people think that portfolio managers, all they do is sit in their office and trade. We rarely trade. Most days, all we're doing is getting a better understanding of potential investments or the investments that we already own in the portfolio. And whenever we're looking at something and doing those things, we put it through our lens, our investment process. The first thing is circle of competence. Do we actually understand this business, what they do, and what this business will look like in 5 or 10 years? And for many businesses, we can actually do that, but for some of them, we can't. And a big part of investing and being successful is just having the humility to say, I can't predict what that business is going to look like, or I don't really understand what that business is, and just saying it's too hard and passing. Do they have a wide moat? And part of that is, a wide moat is it's a term coined by Buffett in the 70s, and it really means sustainable competitive advantage. Capitalism is brutal, and through competitive destruction, any business that's earning high profits, that means competitors are going to try and come at them and undercut them on price or value. So we only want to invest in businesses that have wide moats so that we're comfortable that the company is going to continue to thrive for decades. And finally, margin of safety. So to be honest, it's easy to recognize what the great businesses are in the world, the Visas of the world. But the problem is everybody else knows it. And so it's not very often that you actually get an opportunity to buy a business of high quality trading at a discount to what it's worth. And so what we do is we read, we study, we analyze, we put it on our buy list, and then we just wait until something happens, and then we repeat the process every day. So day after day after day, all Michael and I do is talk about companies and stocks and what they're worth and what's happening in the market. And on occasion, we wake up one day and something's happened to a business that we either own or are interested in, and then we're in a position to update our models very quickly and act. And so I love this quote by Buffett, where he says, beware the investment activity that produces applause. The great moves are usually greeted by yawns. When we're buying these businesses, there's usually something wrong with them. It's not like NVIDIA, where everybody in this room, I'm sure, is talking about NVIDIA. We're investing in things that people either don't care about or dislike for some reason. And that's why they're cheap. When everybody's interested in a stock, that's when they're really expensive. And that's usually not the right time to buy it. So we're trying to go against the grain and look for situations that the others don't see. And so ultimately, I started off with a question: why do only 5% of all investors stick with a value or approach investing from a value investor's mindset? And I think it comes down to this: just discipline. You have to have a really patient temperament, because you don't get opportunities to buy businesses that often that are materially underpriced but yet have a high degree of quality. And you got to stay within your circle of competence. The late physician Richard Feynman used to say, first principle is don't fool yourself, and you're the easiest person to fool. So you got to be totally honest with yourself to make sure you know what you're doing. And I would argue that many people that are investors don't know what they're doing. Demand a margin of safety. And to me, that means not just buying a stock cheap. It also means investing in businesses that don't use a lot of debt. Not using any debt in our portfolio, because unexpected things happen from time to time. And if you don't have any debt, that makes the business resilient. But if you're levered, one mistake or one bad break can really put you out of business. So part of our philosophy is investing in businesses that are going to stand the test of time. And finally, just we're comfortable being contrarian, and I don't know if that can be taught. I know it's true for me, I think it's true for Michael, that we do our own work and we come to our own conclusions. And you can't be contrarian just for the sake of being contrarian. You have to be right. And so what we do is look for situations where stocks have sold off and see, is the market right? And usually the market is right, but not always. And it's those few situations where we see something that others don't, we're prepared to pull the trigger and make an investment, despite the fact that it's not a very popular thing to do at that point in time. And even when value investing is out of favor, that it has been from time to time over the last 12 and a half years, we've consistently stuck to our process. It's also a good idea. The late Charlie Munger said, you know, we're not trying to be brilliant. We're just trying to be consistently not stupid. And you know, in my 30-year career on Bay Street and in financial services, I've seen a lot of stupidity, whether it was the dot-com era, non-fungible tokens, you know, arguably Bitcoin, all these meme stocks. So we try and bring a common sense approach to investing too, to, you know, just stay away from foolish behavior. And Buffett's rule number 1 is don't lose money. And rule number 2 is don't forget rule number 1. So we marry that process, and then what we try and do is build a portfolio of 15 to 20 stocks. A conviction portfolio of just our best ideas. I don't think that a portfolio manager can properly watch 30, 50, 100 stocks in their portfolio and actually keep track of what's happening in each of those businesses. I don't think it can be done. And so I would rather put more money into my best picks that I think are the most attractive and really get to know those businesses and their industries. And it's not just from day one. We tend to hold stocks, we tend to hold stocks for a very long period of time. So we did an analysis recently on how long, of the stocks currently in our portfolio, how long have we held them? And you'll see that we've got 3 stocks that we've held over 10 years. Another one, I think, is 9 or 10 years. Another 4 is 6 to 8 years. So on average, we've held a stock for about 5.3 years. So in addition to helping us get to know the business better, it has 2 other benefits. One is we don't trade very often, which means we, you know, upset our brokers because we're not paying them very much in commission. But also it helps our long-standing clients because we've been compounding capital very tax efficiently. We're not trying to trigger capital gains. If we can buy really good businesses that are compounding their value over time, the hard part is getting the chance to buy them. But once we've done that, we can just sit and let them compound over time and defer the realization of capital gains. So in short, we play a different game. And a friend of mine who runs a podcast that I'm going to be on next week had this great line. He said, the longer the game, the fewer the competitors you really have. And I would argue that the game we're playing, very few people have the temperament and the discipline to do that. And so this is a quick snapshot of the portfolio at the end of the last month, and I just want to point out 2 things. First is the sector breakdown. And we're about 31% tech today, but tech includes companies as diverse as Google and Visa, which I would argue are 2 completely different businesses, different drivers, but they fall into the tech bucket. But if you look at the sector breakdown, it doesn't look anything like the S&P 500. It doesn't look like TSX. It doesn't look like any other index. And frankly, it's not, I'm not trying to create, Michael and I are not trying to create a portfolio of stocks that look like an index. We're trying to make money for our clients by going where the opportunities are, still making sure we have 15 to 20 diversified groups of stocks. And so, again, we're not trying to mimic the index. And the other thing is where the portfolio resides in terms of the companies we invest in. So today, about 84% of the portfolio is in companies that are domiciled in the US. Now, some of them are multinationals like Google that go, you know, so they're selling into places like China and India, but they're in a jurisdiction that respects the rule of law. so that if our rights are abused, we have rights as shareholders. So Michael and I will invest in anywhere in the West, Australia, New Zealand, Western Europe, but we really go to where the opportunities are. We own 9% of the portfolio today is in the Middle East and Europe. We own a Swiss company that I'm going to talk about, 2 small positions in 2 Israeli companies. We own a small Canadian company, and we've got a little bit in cash. And so how have we done? So this is our year-by-year performance since inception, and in 12 and a half years, the average client, we've got a sliding scale fee structure, but the average client has earned 9.9% net of fees since day one. And so $1 million entrusted to us when we launched would be worth $3.267 million as of the end of last month. And what we're trying to do is not just grow our clients' capital, we got to think of protecting the downside. You know, our employees and myself have our entire investment portfolios invested at GreensKeeper. It's not a requirement. They've chosen to do that. And so we're thinking of investing your money identically to how we invest our own. And we worked hard for it, so we want to protect the downside. And so we've only had 1 negative year in our 12 and a half years of existence. And to be honest, that was one of our best years. That was the year that the NASDAQ was down 30 and the S&P 500 was down, I think, somewhere in the teens. So we are cautious. I do want to grow your capital, but I don't want to be reckless about it. Okay, so a question I get asked a lot is now a good time to invest? And I addressed this last year, but I want to try and answer it a little bit differently this year. So is now a good time to invest? No one knows the answer to what the market is going to do over the short term. But let me reframe the question. So if you're a tennis nut like my wife and some of her friends, let's say you grow up playing the game and you're pretty good. From a young age, recognize that you've got a special talent. And so you advance, you start playing in junior tournaments. But as you get higher and higher, the competition gets tougher. So let's say you start playing with your friends and you're winning 90% of the points, and then as you go up, you're winning 70. Ultimately, let's say you hone your game and you make it all the way to the pros. And as a professional, over your career, you win 54% of your points. Just 54%, just slightly over half. How do you think you do over your career? Yeah, you'd be Roger Federer. Isn't that amazing? 54% of his points, he won 86% of his matches, and 20 Grand Slams. And if you look at the other top players, they're all about the same, about 53, 54%. And so what I take from that is, all you need is a small edge, consistently applied over time, over a long, long period of time, can lead to amazing, amazing results. Kind of like a casino. On any one roll of the dice or deal of the cards, the edge in favor of the house is very, very small. And so on any one day or hour, the house can lose money. But over the long term, I mean, who here wouldn't want to own a casino? It's a license to print money. And do you think the casino owners think, well, is now a good time to open a casino? Just open the doors. Keep them open for as long as the government will actually allow you to do that. And so the analogy to the stock market, if you look over the last decades, on average the market is up somewhere between 53 to 56% of the time on a daily basis. So the number is very, very similar. The day-to-day, it's almost a coin flip whether or not the market's going to be up or down today. But over the long term, like over multi-decades, it's up 80% of the time. And so I would say to people that want to play the stock market game, who are day trading or trying to figure out, is the market going to be up over the next month, you're playing the wrong game. The way to get rich in the stock market is to take money that you don't need to touch for the next 5-10 years. This is your long-term investment money. Put it to work in good businesses. Apply a consistent framework like value investing that tips the odds even more in your favor. And then just let time be your friend and continue to compound your capital. Don't day trade. Don't try and time the market when you should and shouldn't be in. I think that's a mug's game. Play a game where the odds are in your favor. Now, with that speech, Nobody does it. Everybody wants to play Bitcoin. People want to invest in meme stocks like GameStop and AMC. And I have no doubt that people in this room have heard stories about people making a lot of money on situations like this. Or weed stocks, somebody asked me about that years ago. There's always going to be a few people that time it right and make millions. Most people don't want to brag about the ones that go to zero, which is most of them. And 0 times, no matter how much you start with, is 0. So don't lose money, play the long game. Okay. So knowing that the stock market's a casino, what's a value investor to do? Own the casino. So we are shareholders in the Intercontinental Exchange, which owns the New York Stock Exchange. They're also a major player in the commodity derivatives market. We are also shareholders in the Chicago Board's Option Exchange, which is the biggest. They're based outside of Chicago, obviously, but they are the world's largest stock option exchange. An amazing business. So all this activity we're seeing in the market, we're benefiting from it, but not by investing in it directly. And I hope that people, if you haven't already, make sure you load up your pockets with Hershey's before you come in. This is a recent addition to the portfolio just earlier this year. Graham, I saw you do it before you walked in. So it's a new and exciting business. It was established in 1894 by Milton Hershey. 50% return on equity, amazing brands. I mean, we all have these in our house. The business isn't going anywhere. They're diversifying into salty snacks. They own Skinny Pop and Dots Pretzels. #1 market share in the US in confection. Beside Mars would be the #2. The two of them are quite dominant. And yet we got an opportunity to buy it just a few months ago when the stock sold off from 275 to now it's trading in the 180s. So why did that happen? Well, there were 2 reasons. One, apparently everybody is taking GLP-1s, Wegovy, and these weight loss drugs, and so nobody's going to eat chocolate anymore. I read numerous Wall Street reports from reputable banks where that's their thesis, that people are no longer going to eat chocolate. Okay? Ridiculous. It's ridiculous. But the second part of the bear case is actually has a little more merit to it. Cocoa is grown in 70% of the world's cocoa is grown in 2 countries in Western Africa: the Ivory Coast and not Gabon, Ghana. Thank you, Michael. And they're having a tough harvest. Their main harvest is in November, but the weather has been a little funky, so they're worried that the harvest won't be very good. And the stock futures are through the roof. Okay, so that's reasonable. Hershey is seeing its cost of goods go up. So how does the company respond? Well, first of all, they're already hedged for almost all of their cocoa inputs for the balance of the year. Secondly, the company has pricing power. They can raise the price of their chocolate bars by 10 cents, and you get a little bit of decrease in demand, but not a whole lot. And third, given their broad portfolio of brands, they can just start promoting brands that don't use as much chocolate in the input. It can be Reese's Peanut Butter Cups, which have some chocolate, but not as much. And so for all those reasons, their earnings are going to be flat this year. The company's probably going to earn $8 or $9, give or take. We think the stock's probably worth about $206. And you don't get an opportunity to buy a high-quality business like Hershey's at a discount. Now, it's not dirt cheap, and we're actually hoping that the stock sells off significantly so we can make it a really big position. But it might not, and at these levels, we think it's a good risk reward, and we have a good opportunity to end up with a really good result. But just to understand our framework when we invest, let's assume that the bears are right and that Hershey's not going to make any money this year. They're going to earn zero. Again, the consensus is they're going to be flat, about $8 or $9. Our intrinsic value would only go from $206 to around $200. Most of the value of any business, Hershey or any other company, is in the tail. It's that cash flow stream of earnings over its entire lifetime discounted back. So even if you lose 1 year's worth of earnings, which they won't, the street tends to overreact. And so we think the stock is mispriced. Another stock we put into the portfolio last year is a Swiss company that you may not be familiar with. It's called Compagnie Financière Richemont, or we just call it Richemont. but you're probably familiar with its brands. Cartier, biggest branded jewelry company in the world. It's founded in Paris in 1847, I believe. Van Cleef & Arpels. This is an amazing business. These are brands that are impossible to recreate. If I gave someone $100 million, I don't think that they could recreate the history and the tradition of Cartier. And luxury is an amazing space to be in because more and more people around the world are getting rich. And one thing that is innate to human nature is that wealthy people want to show off their status. People have been wearing jewelry for thousands and thousands of years for that very purpose. And so it's an amazing business, high margins, 64% gross margins, 18% EBIT margins, returns on capital in the 30% range, earnings continually going up. Management owns they're a controlling shareholder with about a 10% stake in the business. They're long-term thinkers. It's a compounder. This business should compound in value over the long term. But we got a chance to buy it last year at a discount. And why is that? So there were two factors. One was China. Their economy has been soft coming out of the lockdown. And because of the real estate contraction in that country, people are worried. Chinese consumers are big purchasers of luxury goods. That's a legitimate complaint or concern. Also, worldwide recession was the other possible risk factor. But again, Michael and I looked at this and said, this too shall pass. It's an amazing company, an amazing brand, and we were able to buy it in something at about 15 times earnings. You don't get an opportunity to buy a high quality business like that. No debt, excess cash, that we can just sit on for decades and decades. So I hope to see this one in the portfolio for another 10 years. Okay, we're big readers at GreensKeeper. We always have a book recommendation. I think someone took a book last year and said she's read it 3 times, so I hope this year it's the same thing. This year's pick is the checklist Manifesto. It was written by a surgeon, Atul Gawande. And the quote is, under conditions of complexity, not only are checklists a help, they're required for success. And so really the book is about avoidable mistakes and errors that there's a way to minimize these things. And it's really well written. They give a bunch of stories. We've all heard stories of brilliant surgeons, but they forgot a pair of scissors or a scalpel inside of someone. Or they amputated the wrong leg. Like, how does that happen? How do pilots have near misses? And so he does a great job, and a really easy read, to talk about how to get things right and how checklists can be very effective, a way to minimize those errors. And we use it a lot at GreensKeeper. In addition to compliance, Michael and I use it on the research side. And that doesn't mean that it turns us into an automaton where step 1 is you do this, step 2 is you do this. No, we only use it at the end where we're done 90% of our work. And we'll say, have we gone through the checklist? And it's really just, have we done this? Have we looked at that? Most of the time we've done 80, 90% of the things on the checklist, but on occasion, oh yeah, we didn't think of that. You know, I'll give you an example. We do something, before we ever buy an investment, we do something called a pre-mortem. So you're all probably familiar with a post-mortem after something bad happens. A pre-mortem, before we buy a stock, we say to ourselves, if something were to go really, really wrong with the stock, what would have to happen? What do you think would happen? And by doing that, you're anticipating what could go wrong. You're making sure you've thought about the bear case and understand that. It also prepares you for, if you start to see things that are leading to that, it gives you the ability to act more quickly. So I'm a huge fan of this book. I use it in my life for travel checklists. Like I hope you really enjoy it. I think you really will. Okay. We like to have fun at GreensKeeper. I like to spread the gospel of Warren and Charlie to the next generation. And so this year, Michael, my daughter Sarah, her friend Sarah, who worked with me for a summer, all made the pilgrimage to Omaha. I even dragged my sister along this year. And yeah, I don't know if I'm going to go back. That's why it's my last pilgrimage. It was different this year. And you know, Charlie Munger passed away at the age of 99.9 years, as Warren said, just a month shy of his 100th birthday. So it was a little bit different. I love this picture in the middle here of the 3 of them eating a box of See's candy in about 5 minutes. That was pretty impressive. But I put this up here because, again, we like to have a good time at GreensKeeper. And I am absolutely blessed that I get to travel around the world. The best part about the trip to Omaha is not the meeting. I see friends from stocks all the time, and so I've been able to marry my personal life with my professional life, and it's made me a better investor. So I'm very grateful for what I get to do every day. So before I open it up to Q&A, I'll start us off by just asking a few questions that I'm often asked, and the first two are really the same question. What are the markets going to do over the next month or year? Or what's the price of this stock going to do over the next quarter? And the answer is nobody knows. Turn on CNBC, you'll have very persuasive people telling you with a great degree of conviction that they know. They don't know. And will the Fed cut once or twice, or the Bank of Canada cut once or twice this year? And Michael and I always look at each other like, who cares? Does it matter? We know directionally we're at the peak of an interest rate cycle. It's going to start to come down over the next period of time. If you're a highly levered company that's barely making your interest payments, okay, maybe you want to pay attention to when they're going to cut rates. But directionally, you don't need to know exactly. And it's remarkable to me that all the effort that goes into a knowable question comes at the expense of things that we can know. It's a great quote by a guy in Ottawa who runs an amazing blog. So instead of asking those questions, I would posit that there is a better question to ask, that every investor should constantly ask. What's it worth? What's the stock worth? Visa, 2 years ago, everybody was talking about buy now, pay later. The new payment systems that are coming out of India that are starting to transform the Indian payment system. Brazil also has a really interesting new payment system. China has never adopted Visa and MasterCard. So people were saying, well, these companies are dinosaurs and they're going to disappear. Okay, so it's possible. Let's take a look at it. And when we ripped it apart, we ended up publishing a 17-page investment memo on it. And our finding was, in a market that isn't yet developed in terms of payments, new technologies can take over and become the dominant payment method, like they are in QR codes in China. But in a market where Visa and MasterCard are already established, the network effect has never been put aside. So absent regulation, the government can always change the rules of the game. Visa was going to be fine. And Visa compounds in value. You can see it from the stock chart. They grow their earnings 12 or 13% a year after year, plus you get the dividend. And so on occasion, we looked at it 2 years ago and said, we think the stock's worth at least $250. And it was trading at 190-ish. We already owned it. We knew the company well. We didn't take for granted that some of the noise was necessarily wrong, but we did our work and we came to a different conclusion. And so we loaded up. And I think Visa is now our third largest holding. So every time you're looking at an investment, again, ask, what's it worth? And Grant, we have a Google employee here tonight, so I'll try and be careful with my words. Google's an amazing company. It's their second largest holding. So a year ago, all everyone wanted to talk about was ChatGPT, and was ChatGPT going to dislodge the Google search, I'll call it monopoly. They've got 90% market share around the world. Amazing business. So we did a lot of work, and things like the cost of producing an answer to ChatGPT, the compute cost is very, very high. That'll come down in time. But for that and a variety of reasons, we thought that the search business was going to be just fine. Google also owns two really leading AI companies in the UK that they've recently merged. So again, we own the stock, and when it was trading below $100, we added to our position significantly, and it's been up over the last 12 months. So that's how we approach it, is really forget about what the market is doing. Don't think long term, don't think short term, just think long term. Can we predict what this business is worth? Put it on our watch list and just wait for an opportunity to add to our positions. While at the same time always being vigilant to know that sometimes things change and you have to adapt and you have to constantly be vigilant. Okay, two last questions and I'll open it up. I had a client ask me recently, can you address any plans, future plans or lack thereof regarding participation in non-public investments? So we do not invest in private equity or private businesses for a variety of reasons. First is regulatory. So the value fund is eligible for RRSPs and TFSAs, we have to restrict our investments to permitted investments. And what that means is we can only invest in publicly listed companies on stock exchanges recognized by the Canada Revenue Agency. So that's the technical reason. Another reason we won't do private equity is, from my legal days, it's just very different in terms of due diligence. You don't have public information. You don't have the depth of information, so you need to hire really good legal and financial advisors to help you do due diligence. And then finally, they tend to be smaller, so of lower quality generally. So for all those reasons, we're going to stick to public equities on big stock exchanges in countries that favor the rule of law. A final client just yesterday asked me, how do you evaluate a client's or a company's management team? Because I'm a math guy. I love numbers. Numbers sing to me. But we still take a hard look at management because ultimately we have to trust them to run the business right and to allocate capital properly. And so the first thing we do is, it's mostly qualitative, but we want to know, are they honest and ethical? And the way that we do that, are they transparent with their shareholders when something goes bad? We look and see what they say and then what they do over long periods of time by reading transcripts and annual reports. I want to look to see how the board incentivizes them. Are they just incentivized to grow revenue? Or are they shareholders of the company? Do they have a meaningful stake? Or do they focus on the right metrics, in our opinion, which are return on invested capital? And then finally, just their track record of managerial decision making and capital allocation, because ultimately we're at their mercy. And so we got to continually be vigilant. And if a company does something that we don't like and it's major, we'll exit the position because we have to be able to trust them with our capital. So with that, I want to thank you for, there'll be a test at 6 o'clock. Thank you for coming, and I welcome your questions. People are really interested in getting to see the debate. Rob.
You said something about trust toward the end, and that's where you might exit the position. The immediate thing that comes to my mind is the company Tesla. And they have very polarized opinions about the leadership there.
Yep.
So I'm curious what your thought is about that particular company, whether you think that's potentially attractive.
Yeah, that's a good question. Tesla and Elon Musk. So look, Elon Musk is an amazing entrepreneur. He is changing the world. And he will continue to change the world. But in my opinion, he just held the Tesla board of directors ransom and said, if you don't give me $56 billion, because remember, he sold a big chunk of Tesla so he could buy Twitter. But if you don't give me more stock, because 10% isn't enough, and I'm the richest guy in the world, but I want more, I'm going to take AI and my time and attention somewhere else. He may be an amazing entrepreneur, and he is. He's a weird dude, but he's an amazing entrepreneur. I would not put a cent of our money into any company that he runs because I don't trust him. I don't think he cares at all about his minority shareholders. Elon cares about Elon. And so for that reason, I'm out. And to others, good luck, but I don't trust them. Brent.
Question. If we think rates are coming down 50, 75, 100 basis points, whatever.
Yep.
Would you consider taking advantage of some of the higher rates to lock in for, let's say, 1 year, 2 year, to give you a better base to ultimately on the performance side?
Sorry, with fixed income, you mean?
Yeah.
So we're equity investors. So fixed income investor, I'm out of my league when it comes to that. I don't know the answer. So as equity investors, when I was talking about what rates are going to do, we just try and figure out directionally where they're going. Because even if Michael and I could tell you exactly when they were going to cut and by how much, even if you knew that, I don't think it helps you as an equity investor because you don't know how the market's going to react. As a fixed income investor, yeah, if I'm buying a house and what I'm paying in interest payments will really matter depending on should I lock in or floating, that matters. But it's beyond the scope of what we do at GreensKeeper. John.
Mike, you're currently at roughly 140 million.
Yeah.
15 to 20 core investments.
Yep.
At what point do you have to expand the number of core investments to the size of the fund?
Yeah, we really don't, to be honest with you, John. Like the companies we own today, the market caps are massive. We own two smaller companies where it would be difficult. If we were $1 billion today, I don't think we could buy them. But the other 15, 16 investments we have in the portfolio, we wouldn't have any problem putting money to work in Google or Amex or Berkshire or Intercontinental Exchange, CBOE. I mean, the average market cap's probably somewhere in the $20 billion range. So we don't have a problem putting capital to work, and our business is really scalable. There may be the occasional situation that we can't play in. We're looking at a Canadian company at present that if we were $1 billion, we probably couldn't buy a 5% position that we're thinking of doing. But at 140 million, we can. So it's not hard. We would just pivot a little bit. But we're nowhere near where I think it would start to hurt client returns in terms of our assets under management.
In today's market, are you seeing more or fewer good opportunities?
So it's hard for me to compare, because when I look at, I still think at times like 08, I think of COVID, and it was shooting fish in a barrel, like things were cheap. But today I'd say we're working hard to find 3 or 4 really good ideas in a year. Hershey we added this year, Richemont we added a year ago. We picked away and added to existing positions, but the market's not cheap. I wouldn't say that it's frothy, but I wouldn't say that it's cheap. There are areas of froth, but there are other areas of the market where we're still finding value and putting money to work. So I don't know. It's hard for me to say. Every day we just put in the work to see if we found anything, look at our watch list, and then one day we wake up and something's happened, and we pull the trigger 24 hours later. Alan?
Do you own Costco, or is it on your watch list?
Costco is an amazing business. I've looked at it for a long time, and I know Munger's a huge bull, I should say, or was a huge bull. It's just never been cheap enough. I don't think it's a good investment at that price. It's an amazing business. We spend a lot of money there daily. But even the best of companies can be bad investments if you pay the wrong price. So it's just, and I've been wrong. I looked at it when it was 50% of where it's trading now, and I thought it was expensive. So I just can't get there.
Waiting for, it's on your watch list.
It's on my watch list. I don't know that I'm ever going to get a chance to buy it, because it's a cult stock now, right? So I just tend to pass, and maybe I hope somebody finds a rat in something, a jar of peanuts, and I get a chance to buy it at 10 times earnings. But we're cheapskates. I want to buy the best businesses, but I want to buy them when they're on sale. So we're very picky. Lynn?
I'm just wondering how you're responding to political issues, like the issues in the Middle East.
Yep.
Israel and Palestine, and what's happening there, and how that impacts your investments.
Yeah, so I try not to get into politics as an investor, because I think different people have different views, and I can respect both sides. But the way I look at political risk is, what's the risk that it potentially affects our investment if something happens? If there's a war in the Middle East, I didn't predict that there was going to be a war in the Middle East. We own a software company based in Israel. I would say 95 to 97% of their sales are around the world. They just happen to be based in Israel. They're a cybersecurity company. So the fact that they're domiciled there, it doesn't bother me. And look, if I knew there was going to be a war, I wouldn't have bought a new Israeli company, because one of the businesses is the Visa of Israel. An amazing business, but the activity, the level of activity in the country has gone down. I just try and think long term. I don't want to walk into trouble, and I won't invest in a place like Kazakhstan or Russia or China, where I can wake up and the rules of the game have changed and I have no legal redress. But otherwise, I just think about, look at the presidential election. Very divisive. People are going to have very different views on both of them. I think they're both donkeys personally, but that's just my opinion. Will the Republic continue to stand? Yes. Are tariffs going up? Probably. I just try and think of the business environment and how that's going to impact our specific investments, and think about, is there something that we shouldn't own because we're afraid that Trump or Biden is going to do something? So that's how I think about politics.
Thank you.
Chris? You good?
Who knows, that's all.
yeah, a lot of things are unknowable, you know. So we just try and pivot and invest in good businesses. Well, I'll let you go watch the debate, and I want to thank everyone for coming, but we're going to be around for a while, so grab a book, stuff your pockets with some Hershey's, and get yourself a drink, and I'll see you next year. Thanks for coming.